Welcome to this course on insurance. We are in trimester 1, module 1 and chapter 5, fundamentals of general insurance. And in the fundamentals of general insurance, we are going to study the fundamental aspects of general insurance, and we will be talking here of the history of of the history of insurance. What is a risk and what is the difference between a pure risk and a speculative risk? And we will also discuss the characteristics of an insurable risk. So we go into session 1 on chapter 5, the fundamentals of general insurance. A history of insurance. Some primitive form of insurance has been present for quite some time. See, whenever there is a business enterprise or whenever there is an adventure, whenever people move out, there is a risk. And how do we manage the risk? How do we face the consequences of the risk? This has evolved over a period of time. Initially, some preliminary models of insurance were indeed available. In fact, they were available right from 1750 BC. The Code of Hammurabi does mention about insurance as practiced in the Babylonian system. And it was practiced by Mediterranean sailing merchants, where that insurance was very simple, but essentially it's the same model that we use today, where somebody finances for a shipment of cargo, of a consignment, and this consignment has to be transported through sea. And those days, transportation by sea entailed a lot of risk. The ship could sink, the consignment could be lost, and a lot such risk. So those who financed the shipment, they said, in addition to while paying the loan, they kept aside a small amount. They said, in case the shipment is lost, you need not repay the loan. So this was a kind of a preliminary model of insurance. But as a business model, this could not survive for quite a longer period of time. Even in Genoa, in Italy, in the 14th century, separate insurance contracts were developed. But the one event in London, it happened on September 2, 1666. There was a great fire, the Great Fire of London. It raged from September 2nd to September 6th in the year 1666. Around 700 houses were burnt. Lot of property was lost. And then the fire insurance began. The fire insurer, the first fire insurer, started office in 1680. And another important development in the history of general insurance was the opening of a coffee shop. Edward Lloyd opened his coffee shop in 1687. This coffee shop was frequented by sailors and others who are concerned with the naval trade, and slowly information on movement of ships, on the consignment carried and the destinations emerged from the Lloyd's Bulletin, and a form of marine insurance also developed, whereby the ships as well as the cargo were insured against several maritime perils. When we say maritime perils, we mean dangers associated with voyage by sea, ocean voyage. And today, Lloyd's is a very big institution. It is a market in insurance and reinsurance where the syndicates transact insurance. Apart from marine insurance and fire insurance, life insurance also became more professional around 1760, 1770 when mortality tables were developed and actuarial science also developed to predict the likelihood, the probability. See, we should always remember insurance is founded on probability theory. The development of probability theory and the developments in probability science has helped insurance development in no small measure. So, around 1700 and 1800, insurance became an established business. Not only as a business model, but also as an important organ for society, an important facilitation for business. So insurance protected against risk. We keep on using the term risk when we talk of insurance. We say insurance protects. Protects against what? An umbrella protects against rain. Sorry. What does insurance protect us against from? It protects us against risk. What risk? What is risk? Yes, we should know what a risk is because the term risk is used by all of us at different points of time. And it means different things to different people in different contexts. In the context of insurance, what does the term risk mean? What is a risk? A risk is a deviation from an expected outcome. But there are so many deviations from expected outcomes. I might have invested money in the stock market, bought a particular share for 2000 rupees per share. Let us say I bought 1000 shares. 1000 into 2000, 2 million, 20 lakhs. I bought with an expected outcome that 1 month from now, the price of the shares would go up from 2000 to 2500. That means the market value of the shares I have bought will move from 20 lakhs to 25 lakhs and I make a profit of 5 lakhs. This is my expected outcome. But unfortunately, there was a deviation from the expected outcome. Instead of moving up, the price of the stock went down and it came down to 1500 rupees per share. Now what is the market value of my share? 1500 into 1000, 15 lakhs. I invested 20 lakhs. There was an expected outcome that I will make a profit out of the investment, but there is a deviation from the expected outcome. I end up having a loss. This is also a deviation from an expected outcome resulting in a financial loss. But the only thing you need to remember in insurance is, first thing, insurance covers us against financial loss arising out of a deviation from an expected outcome. But not all kinds of financial losses are covered. Some of them are covered, some of them are not covered. Which are the types of financial consequences of a risk that are covered and which are not covered, we will discuss. There are two types of risks, pure risks and speculative risks. What are pure risks? Pure risk means there is a loss or there is a no loss. There is never a gain in a pure risk. A pure risk is an involuntary condition. Involuntary means I cannot control the outcome or I did not choose the outcome. I am going on the road to buy 2 packets of milk from the nearby Kirana store. A speeding truck comes and hits me. I had no control over the outcome. It was involuntary. I did not jump in front of the truck. I was walking, but the truck came and hit me. This is a pure risk. I am taking a walk in the park. A snake bit me. I did not invite the snake to bite me. It is an involuntary act. It is a pure risk. Again, I am walking on the road. Poor fellow, there was a coconut tree nearby and the coconut fell on my head and I died. Again, I did not ask the coconut tree to come and fall on my head. It is an involuntary act. There is a consequence resulting in financial loss. Yes, if I die, I don't earn any more income. That is a financial loss to my family. So pure risks are those risks which result in losses arising out of involuntary condition. Nobody chooses this action. Nobody chooses this course of action, or at least not this consequence. The consequence of dying, the consequence of a building catching fire, the consequence of a building getting damaged by earthquake, the consequence of the financial consequence of a factory getting damaged by flood, the financial consequence of a shop being burgled, the financial consequence of a person, the breadwinner, getting killed in an accident. All these are all involuntary conditions which result in financial loss. Or there is no loss. I go back, buy my packet of milk and come back home happily. The building is safe. The factory runs safe. So there are only two outcomes possible in pure risk. One is either there is a loss or two, there is no loss. There is no gain in a pure risk. In contrast to a pure risk, in a speculative risk, first thing, it is a voluntary undertaking. I choose to trade in stock. I choose to invest in real estate. I choose to gamble. These are all voluntary actions and there is a consequence. There could be a profit also in speculative risk. In pure risk, there can never be a profit. In speculative risk, there could be a profit. I invest, the stock price moves up, I make a good fortune. Or the stock price moves down, I lose a fortune. So there could be three outcomes. Either a loss or a profit or no loss, no profit. So speculative risks are like investing in a stock market or investing in real estate, gambling, or even a shop. I open a shop and I buy a lot of goods with the hope that they will be sold, but nobody buys from my shop. All the goods rot. This is a speculative risk. There could be an element of enterprise involved in it, but it is a speculative risk because it is a voluntary condition. It is a voluntary undertaking that we take. Why speculative risk cannot be insured? Because there are few things. The outcome and the financial consequences, calculating them in speculative risk could be difficult. And second thing, as a business model also it might not work. If there is an insurance for trading in stock, if there is a loss, they will come to you. If there is a profit, they pocket it. Eventually, the losses would be too much and it cannot be borne by an insurance model. First thing, how much would be the loss and how much should be collect as a premium itself cannot be predicted. And as a matter of policy also, speculative risk should not be insured. So speculative risks are not insured. Pure risks, there are many of them. I am not listing all of them. Nobody can list. As long as there is an involuntary condition and as long as there is a risk resulting in a deviation from an expected outcome, resulting in a financial loss, there is insurance. But not every kind of pure risk could also be insured. We will say what are the characteristics of an insurable risk a little later. Now before that, a summary of the difference between a pure risk and a speculative risk. Outcome is loss or no loss. In speculative risk, either it could be loss, it could be a gain, or no loss, no gain. And who controls? In pure risk, it is not under my control. The truck, I don't drive the truck. Somebody drove it and hit me. The coconut fell on my head. The snake bit me. All these events are outside my control. But when I choose to gamble, it's conscious. I invest some 1,000 rupees, then 10,000 rupees. I keep on investing more and more money with the hope that I need to get back the amounts I lost. It's a conscious decision. I am aware of the losses I might sustain, and yet I am consciously taking the decision. Yes, there could be a loss, so what? There could also be a gain. In pure risk, there can never be a gain. So as I mentioned, accident, death, illness, natural disasters, liability, all these things are examples of pure risk, whereas speculation, enterprise, adventure, all these things could be examples of speculative risk. Now, when we talk of pure risk, how do we manage them? Yes, there are risks, and how do we manage them? A very, very brief snapshot on risk management. There are 4 possibilities. When I talk of frequency and severity in this grid, please remember, severity means how big the loss could be. Is it a small loss or a big loss? Frequency means how frequently the loss would happen. Would it happen every day? Would it happen once in a year? Would it happen rarely? So, this grid talks of 4 possible combinations of frequency and severity. The first one is a low frequency, a low severity. Low frequency means that it does not occur every day but occurs rarely, and low severity. Whatever I lose is not big. For instance, I am running a shop. It's a single person shop, so I watch the customer. I know he talks to me and he buys and goes. Sometimes while I'm talking to one customer, another customer could sneak out with something on display. He might have stolen something. It doesn't happen every day because I am watching carefully, but it happens occasionally. So that is a low frequency, and whatever is stolen is also what is on display. Some chewing gum, some pen, some material which is not very costly. So low frequency, low severity. So this is possible that it is available, it happens. And what do you do? Retail. I mean, this is part of the trade. You can't go in for insurance because it happens rarely and the amount is small. For claiming a small amount, why should I first pay the insurance premium, get the policy and take all the trouble of claiming it? So I would rather retain the loss. There is another type of loss. It occurs quite frequently, but yet low severity. For instance, let us say that I am running a restaurant. So we supply water and cool drinks to the customers in class. And there is so much of rush. The bearers keep moving around tables and almost every day some 5-10 glasses are broken. This is high frequency but low severity again. The cost of a glass might be 100 rupees. So some 3-4 broken, 300-400 per day. But for a business with a turnover running to lakhs, this is not a big amount. So, but at the same time, I have to address the risk. I have to reduce. I have to tell the bearers to watch to watch their movement. I have to see that the floor is not slippery, or I might even change glass to unbreakable glass. There are other options. So here again, insurance is not an option. I will have to take it to my own account. But at the same time, because it is high frequency, I have to reduce the amount of loss. There is a third item which is rare but possible. High frequency and high severity. Very high frequency and high severity. Let us say I own a factory just abetting a river which frequently floods. The river keeps on flooding so many times, and every time the flood, because my factory is just abetting the river bank, every time there is a high loss. So high frequency and high loss, and insurers might not be interested in this proposal, in covering this proposal. So what should I do? I have to avoid. Either I should avoid constructing a building just by the river bank, or I should store them in upper floors so that even if there is a flood, it recedes faster and the upper floors are not damaged. I have to avoid the risk, avoid keeping such high frequency, high severity risk. I cannot retain it and I cannot reduce it. Better avoid the risk. Don't do anything which will cause you frequent losses of a high severity. The last one is low frequency, high severity. This is something which can be insured. It is not too frequent, and if at all it happens, the loss could be for a very high amount, like an earthquake, like a fire, like a flood. So a low frequency, high severity unit and high severity risk is better get transferred. When we say risk transfer, we mean the financial consequences of the risk are hereafter borne by the insurer. If I have not insured my factory and my factory is burnt by a fire totally, the cost of the factory is gone and I have to bear it myself. But if I have paid a premium for the factory, if I have paid insurance premium for the factory, the financial consequences of the property catching fire get transferred to the insurer, because now if the factory catches fire, the insurer will pay the money. Therefore, I am saved from the financial consequences of my factory getting burnt. This is risk transfer. Risk transfer is usually done through insurance for pure risk. So I also mentioned that not all pure risks are insurable. Only a few of them could be insured. What are the characteristics of an insurable risk? We would see that. So what are the characteristics of an insurable risk? There are 7 such characteristics which distinguish an insurable risk from an uninsurable risk. What are those 7? I will tell you one by one and then I will explain to you. Number 1, large number of homogeneous exposure units. Number 2, independence among exposure units. Number 3, calculable expected loss in monetary terms. Number 4, the loss has to be definite as to time, as to place, as to the amount and as to the cause of the loss. Because if the cause of the loss itself is uncertain, we won't even know whether the risk is insured or not. I will explain. And number 5, fortuitous loss. Number 6, economic feasibility. And number 7, avoidance of catastrophic potential. We will go to the number 1 characteristic. Homogeneous exposure units. You need large number of homogeneous exposure units. Why do you need large numbers and why do you need homogeneous exposure units? Why large numbers? Later, we will be studying the law of large numbers. So we should remember that in insurance, insurers are capable of predicting the probability of a loss occurring in future. This capability is achieved by studying past records, large number of records of past losses, of past exposures. That is one thing. The second thing is, now you should also spread your risk across large number of exposure units so that it becomes viable. So we do need large numbers. We can't just have a single person seeking a unique insurance. In that case, the insurance is a loss sharing mechanism. If there is only one exposure, where is the loss sharing arrangement? Therefore, you need a large number of units, large number of customers with whom we can spread the risk. The risk here, again, remember the financial consequences. And why homogeneous? Homogeneous means having the same risk characteristics. If I am selling health insurance, old people and young people cannot be a homogeneous group because the probability of hospitalization for an old person is significantly higher than the probability of hospitalization for a younger person. Therefore, you need to collect a homogeneous group of exposures. So homogeneity is important. So the first element in choosing to cover an insurance is a large pool, large and homogeneous. Now I was mentioning homogeneous. Remember, homogeneous means what? See, here is there homogeneity? No, because different types of fruits. You have a banana, you have a strawberry, you have pear, you have grape. These are different. They are not homogeneous. This is not a homogeneous exposure. But this is homogeneous. Almost identical apples. Similarly, in insurance, risk should be grouped, clubbed according to their exposure, loss exposure. In cars, taxis are different, other private cars are different, trucks are different, passenger carrying vehicles are different. Within passenger carrying vehicles also, a small bus carrying not more than 18 passengers or a larger bus carrying 60 passengers, they are different. So depending on their characteristics, they are classified, which we will discuss later. So you need homogeneous large group of exposure. So that is point number 1. What is point number 2? There should be independence among exposure units. Please understand, insurance, we are calculating the probability of a random event. If there is independence among the exposure units, in the sense that one loss will invariably lead to another loss, and the second loss to the third loss to the fourth, if so much of interdependence is available between these losses, then just one event could result in 4 or 5 losses arising out of the same accident. This kind of interdependence could result in spiraling losses. Therefore, they should be independent. One loss should not necessarily lead to another. So an insurer would always calculate the accumulation and see whether there is interdependence between two adjoining risks. He would not like to be exposed to a situation where multiple risks are covered in the same location, where a fire could spread from plant A to plant B to plant C. These kind of interdependence an insurer would avoid. So there should be independence among exposure units. Number 3, it should be calculable in monetary value. Sentimental value has no place in insurance. All of us have sentimental value attached to certain things, like if my father could have gifted me a pen. For me, it is not just a 50 rupee pen or a 100 rupee pen. It carries so many positive memories about my father, it is invaluable. But such kind of sentimental value has no place in insurance. In insurance, it should be calculated in monetary terms. If there is a risk, if we are talking of a financial loss of a property whose value cannot be assessed in monetary terms, it cannot be insured at all. As simple as that. Number 4, the loss should be definite as to time. Why it should be definite as to time? Because insurance, either life insurance or general insurance, it is issued for a specific period. So I should know when the loss happened. Is it during the period that the policy was in force, or did it happen later? So whatever risk I insure, the losses that I am covering should be identified as to time and also as to place, because sometimes I may insure a particular geography, a particular territory, a particular location. I might have inspected the risk and I know it is at this place. So if the loss happens at this place, I will cover, not if it happens at any other place. And also amount, as I already mentioned, the amount of loss should be determined in monetary terms, and cause of loss, because please understand one thing very clearly. Even in a pure risk, not every type of loss is covered. Fire is a pure risk, but every kind of fire is not covered. There is no insurance company in the world which covers every type of fire. There are certain types of fires which are excluded. Like, there could be a fire during a war. War cannot be covered. There are certain types of fire which are inevitable. These are excluded, like spontaneous combustion. When you study fire insurance, you will study these things in detail. So, if a loss happens, the insurer should know whether the loss arose out of the danger for which it has been insured. The cause, what is the cause? Did it arise out of a peril which is insured? Therefore, a characteristic, one essential characteristic of insurable risk is the loss should be definite in terms of time, in terms of place, in terms of cost, and in terms of amount. And number 5, fortuitous. It should be accidental. It should be unforeseen. It should be unexpected. If it is definite to happen or very, very likely to happen, there will be no insurance. If I am sick, I have all conditions which could result in a hospitalization. And if I seek health insurance, an insurer might decline. Why? Because in my case, it might not be entirely unforeseen. If I am already afflicted with too many conditions which might warrant a hospitalization in the immediate future, it is not unforeseen. It is not, therefore, it may be avoided. Similarly, you saw there are cases of high frequency events. A high frequency event, I would say, cannot be totally unexpected because you know pretty well that these keep on happening regularly, very frequently. So such things could not be termed to be unexpected. It has to be accidental, unforeseen, unexpected, a rare event. This is an important characteristic of an insurable risk. And number 6, economic feasibility. I cannot, earlier also we mentioned, if there is only one unique risk, I cannot design a policy. It could be, and insurance is loss sharing. I need large numbers, and if it is only one risk and even the premium is very low, it may not be economically feasible to cover, especially when there are not large number of risks involved. Therefore, an insurer could avoid such a risk. And last, avoidance of catastrophe potential. Certain catastrophes insurance has evolved to address, like earthquake, like flood. There are big losses running to billions of dollars arising out of such natural events. But certain events, nobody could even foresee what could be the amount of loss, like a loss during war. A war could be so devastating to the economy of the country that no insurance company would be in a position to handle this kind of loss of a catastrophic potential. Similarly, a nuclear war or even a nuclear leakage, even during in a nuclear energy installation, the losses could be huge, of a very high magnitude, which cannot be handled by an insurance or reinsurance company, and therefore they are best avoided. So friends, in conclusion of this session 2, we have seen the characteristics of an insurable risk, 7 of them, 7 characteristics. These distinguish how and why a risk could be insured, or why a risk cannot be insured. There has to be a large number of homogeneous exposure units. Exposure units means what we cover. It could be lives, it could be factories, it could be cars, it could be houses. So what are the exposure units? Do we have large, and are they homogeneous? Then there should be independence among these exposure units. The loss should be capable of being calculated in monetary terms. The loss should be definite as to when it took place, where it took place, and what caused the loss, and the amount of loss should be determined. And it has to be unexpected, it has to be unforeseen, it should be accidental, and it should be economically feasible. And last, it cannot be of such a catastrophic potential that no insurer or reinsurer would be able to cover it. So these are the 7 characteristics of an insurable risk. In this session, we briefly dealt with the history of risk, history of insurance, and then we saw what is a risk and what are the characteristics of an insurable risk. We also discussed what risk could be insured between pure risk and speculative risk. Pure risk could be insured, but not all pure risk. They have to possess some characteristic. What are they? We discussed just now. We will discuss a lot more interesting things on insurance in the next sessions. Bye.